Good evening to you all. Welcome to Your Money, Your Call. I'm Nina May. Well, joining me tonight to take us through today's market action and, of course, take your calls live on air are Roger Montgomery from rogermontgomery.com and Owen Beattie from Kinetic Security. The mechanics of what happens in Greece and Spain seem so far away from what the average Australian investor deals with, but it does have an impact on our market. It involves worldwide sentiment, doesn't it? And as Owen was saying, you mix that with some ordinary results and it ends up not being a stellar day.
I think it's a big mistake to make micro investments. So we're investing in the Reject Shop or JB Hi-Fi or Toll or whatever the company is, yet a lot of people make their investment decisions in those companies about what they see on the front page of the Wall Street Journal or whatever it is. You know, the reality is that what happens in Greece is going to have zero impact on how many $2 toys the Reject Shop sells. It'll have zero impact on how many CDs JB Hi-Fi sells, yet the share price moves around a lot. You know, Benjamin Graham, who, as you know, is sort of Warren Buffett's mentor and wrote the seminal work on security analysis, you know, he said in the short run the market's a popularity contest or a voting machine. In the long run it's a weighing machine. You know, I scratch my head. I heard Owen saying he scratches his head today. If I looked at the market at that level of detail, I'd be scratching everything all the time. I'd rather think about what the businesses are worth. And when I aggregate, and I've said this to you before, that when I aggregate the valuations of all the companies, all top 200 companies, then I get an index valuation of about 39.80 or thereabouts, 4,000. So for me, the market is still more than 15% over its value. Now that's not a prediction about what the price is going to do. I'm no good at predicting that. But I know what things are worth, and at the moment the market seems expensive.
Gentlemen, we're going to take our first caller for the evening. In Perth, we've got Brian on the line. Hi, Brian.
Hey, could I get the panel's view on Fleetwood, FWD? Thank you.
Okay, Fleetwood is the... oh, there you go.
I have to declare my interest.
Roger, well, we can start with you. You do own it. As you say, it's about $8.09 today.
Yeah, I'm very happy about that because I bought it in March last year at about $3.50 and kept buying it up to about $5. Look, I think it's a great business. Terrific return on equity. There's one thing about this business that I don't like, and it's the only thing I don't like, and that is the number of options that are issued to the executive team. It's the only thing that I look at and think, gee, I wish they didn't have that there. Having said that though, great return on equity, relatively stable business. If you believe the story, the China story, well, they've got exposure to that, although the recent results weren't that great.
I was just going to ask you, sorry, for those who are not aware of what Fleetwood's involved in.
Okay, sorry, Fleetwood is the second largest manufacturer of mobile caravans in Australia and one of the largest manufacturers of mobile accommodation for mine sites. So, you know, the villages that they create.
The dongers and those sorts of things out in mining sites, yeah?
I don't even know what a donger is, but...
Well, I think that's what they're called. Isn't it? Is that right?
I learned that the other day. It was a donger.
Yeah. That's what,
right,
that's what they're called. And
very good.
Thank you.
Oh,
it's a temporary, it's a temporary accommodation. It's in mining sites, I believe.
I don't know any miners, so I don't know what a donger is, but good, if it's a donger, it's a donger. So they do a great job. High return on equity, pay most of the earnings out as a dividend. So it's a bit, so in valuing the company, it's a bit like a bond. And what I mean by that is its equity stays relatively stable, its return on equity stays relatively stable, and it pays most of its profits out as a dividend. So you can value it pretty much the way you value a bond. Now, I think it's worth between $6 and $7. It's not worth where it's trading at today. But because I bought the shares at $3.50, $4, $4.50, $5, my dividend yield on that is 25, 26, 27%. I can't replace that, so I'm kind of interested in hanging on to it. I think it's a great business. I don't think it's particularly cheap at the moment. I'm very, just on the China story, because I've been doing a bit of work on this just in my relaxing time, my semi-retirement. So one of the things that I've been looking at, I spent a bit of time in Asia in the mid-90s, and I remember being in Malaysia and looking across the skyline, the horizon. You know, it was 96, I think, and yeah, 96, and I remember the cranes. You know, the cranes were just as far as you could see. There were cranes everywhere, and I had an interpreter with me, and I remember asking, why is that there was a building being constructed, and who's building that building? And the guy said to me, he said, look, This guy went to school with the guy who's building that building over there, and he just wants to have a bigger building than him. And I just thought, that's ridiculous. And then I asked the population of Kuala Lumpur, and I realised that when they built all these offices, there would be more office space than what the entire population of KL needed. Now, that was a year before the Asian tigers fell over, and we had the Asian currency crisis. Cranes on the horizon in Dubai. Credit-fueled property boom, and then it went bust. Then I was in Miami in December 2007. Same thing again, as far as the eye could see, and that it was where people
you should
already
stop travelling, Roger.
I know. But let me tell you, China right now. China today has 30 billion square feet of residential and commercial office space being constructed. Now, that is 23 square feet for every man, woman and child in China. That's more than they're ever going to need. It takes 8 years to pay off an apartment in London. It takes 11 years to pay off an apartment in New York. It takes 39 years to pay off an apartment in Beijing. There is a property bubble in China right now. When they stop constructing all those apartments because they're done and they've realised we've got enough, well, I'm a little bit concerned about suppliers of building material products to China. So there's a whole bunch of them in the Western world, including Australia, and I'm a bit concerned about that.
Australia's certainly affected by that. Gentlemen, we're going to have to move on to our next callers. We've got no, it's okay. Tyler in Sydney, thanks for your patience. Hi, Tyler.
Hello, I'm actually reading The Intelligent Investor now, but what I was calling about is how do you identify all the companies with durable competitive advantages? And I've been looking at the banks because they've got high switching costs and they've got competitive advantages themselves, being a quadrupoly. I've looked at ANZ and Westpac, and Commonwealth I think is a bit too pricey, but ANZ doesn't spend as much capex each year and you get more cash as a shareholder. What do you think about the durable competitive advantages and the banks?
Okay, Owen, I'll go to you for this one. First up, ANZ, we're looking at in particular here. We're just going to try and keep things share specific, guys, because we've got lots of callers to get through. So sure. $22.25 is it's okay, is what we're looking at. Down by 27 cents today. So, Owen, your take on that?
Okay, very quickly, my take on the banks. Our preferred banks are CBA and Westpac from a fundamental perspective. CBA might be a little bit overpriced if you were to look at it right now. But from our perspective, as far as shorter-term trades, which we predominantly look at, CBA and Westpac are the two that we've been looking at.
Now, I've got to declare, I know Tyler. He's sent me a couple of emails and I've replied. The most valuable competitive advantage, Tyler, is the ability to raise prices. Banks have that in Australia. The other competitive advantage that they have is people don't switch. There's a lot of inertia, and so they can charge whatever they like. In terms of banks, CBA, I hear what he's saying about cash flow. CBA, and if he can calculate the cash flow of a bank, amazing guy, we should get him on the show. CBA has a high rate of return on equity, but it's expensive. The other banks have much lower rates of return on equity, but they're about the right price at the moment. I don't see a lot of value there at the moment.
We've got Annette in Melbourne. Annette, hopefully we can help you though. What's your question tonight?
Yeah, hi. I'm ringing about Highlands Pacific. I rang another time and they discussed a different company. It's a gold and copper producer in Papua New Guinea, and I believe their return on equity is 12% plus. Okay. And they've been saying that they're free carried by Extrada. I'm not really sure what that means, but apparently they've got products of gold and copper coming out for the next 20 years.
So we're talking about Highlands Pacific? That's right. HIG, the stock code, and there we have the chart on the screen.
Okay, well, let me talk about return on equity. If I don't follow Highlands Pacific, but a 12% return on equity is a mediocre rate of return. It's not it's not going to knock your socks off. And in terms of having gold and copper for the next 20 years, well, there's 1,000 companies that have gold and copper for years and years ahead. And I keep saying this with every one of these companies. They are selling a commodity. In order to value them, you need to be able to forecast what the copper price and the gold price is going to do, and I'm just no good at doing that. I can't forecast those things with any degree of accuracy, so I find it very, very difficult to value these types of businesses. I'm interested in the producers, and there's a very simple ratio to look at. You want to know how much does it cost them to get an ounce of gold out, and what price are they able to sell that for, and that's where the leverage comes from. But whether it's Highland Pacific or 4 white pegs in the ground, no liability, you've got to forecast prices for commodities. Very difficult.
Owen, can you add anything to that one?
I think Roger's pretty much hit the nail on the head.